All right, welcome traders to this week's market bias recap report for Sunday, July 23rd. Diving right in, I'm going to try to keep it short and sweet today. S&P 500 continuing to be bullish. We have not broken any of the pieces of the trend that we really care about. We are in the midst of a pullback that we've been saying we've needed for a while. Thought we were going to get it here, didn't. Bulls stepped back in. Now we're coming back down, testing the 9 EMA. If we hold support on the 9 EMA and start to move higher again, honestly, I am probably going to exercise patience at this point. I would love a deeper pullback coming back down to the support around 4,500. To me, these charts are still overextended. If we go out to the weekly chart, you can see what I'm talking about here on the RSI. Momentum on the MACD still looks good, however, but on the daily chart, you'll see we had this kind of double top on the RSI and actually a lower top on the MACD here. And that is oftentimes an early indication that there might be a larger correction coming. Not saying that now is the moment, because like I said, we do have the solid uptrend in place. We are still making higher low pivots on each pivot so far, so therefore the trend is intact. But this is divergence on the MACD and also kind of a slight divergence. This is a not drastic decline, but still a decline on the RSI as well. So honestly, being very, very conservative at the top of the chart, waiting for a larger pullback and probably some time consolidation there as well. We also have a lot of economic data coming out this week. We will get to just in a second. So the mantra for this week is going to be patience and conservative positions. Going out to the NASDAQ, very similar picture. We did get actually a little bit more of a sell-off here. You'll see we actually broke the 9 EMA and we are now pushing in to test the double top here and support around 15,400, let's call it. And we also had the double top in the RSI here, and we did just set another lower pivot on the MACD as well on the NASDAQ. So similar. One thing to note, we actually had an increase in volume on the sell-off here from the NASDAQ, whereas if we go out to the S&P again really quick, you'll notice we didn't have a big pop in volume on this. So between the two, I'm leaning more into the S&P 500 and staying a little bit further away from the NASDAQ right now. And that can actually also be confirmed here. So I've shown the FinViz chart before. This is a heat map showing the movements for 1 week time duration. So this was the total price gain or loss for all the stocks listed here over the last week. And you can see the biggest losses were in the big name tech. We've been saying for a while this was overextended, that they really needed to pull back and give some back up and chill out, to be completely honest. So we have started to see that rotation that we've been calling for in our videos the last couple of weeks. We're seeing that rotation go into other areas of the market like healthcare, consumer defense, energy is a nice one to keep an eye on, and financials is a good one to keep an eye on. I'm expecting that trend to continue, but that is part of the reason that we are seeing the NASDAQ showing a little bit more weakness and the spike on volume for the down days as opposed to the S&P 500. The S&P has more width and breadth. So when money rotates out of the big dogs, it doesn't hurt the S&P as much. And going back to this just for 1 second, the size of box on here shows in comparison to how much they are market weighted. So obviously Google, Microsoft, Nvidia, Amazon, Tesla, Apple, those are basically the biggest stocks for market cap in the entire stock market. And when they move, it hurts. So when money moves out of some of the smaller areas of the S&P and into other smaller areas of the S&P, it doesn't hurt as much as a big drop in those big names because they carry such a heavy weight on the NASDAQ. So anyways, a little tip there if you ever want to check that out. Going out to the Russell 2000. We're getting a nice healthy pullback here. We are basically sitting on support right here on the rising 9. It's hard to have a super strong read here. And the reason that I say that is we had slight increasing of pivot highs on the RSI, confirming the uptrend, but we also had lower lows that is divergence from the uptrend. So we're kind of getting mixed signals here. If we put this out to a weekly chart, basically you'll see we're still in this zone here. We're basically triple topping against resistance at about 2020. If we get a deeper pullback back down to around 1900 or 1920, somewhere right in there, I would be interested in potentially playing a bounce there. But we're kind of in the middle of that range between these two horizontal lines that are acting as support and resistance. And since we're in the basically exact middle of that, there isn't really an edge to be seen one way or the other this week. So I'm probably going to be discounting this on the daily chart because of what I'm seeing on the weekly chart and giving those two ranges. Finally, going out to the Dow Jones. Dow Jones finally waking up. We've been talking about this zone right here for quite some time, around 35,000. It had held true all the way back to March, and then actually acted as resistance back here in late last year as well. Finally did break out of that. We did have a little increase in volume, but it's still stuck pretty much around average, so nothing to write home about on that front. Looking for a pullback here back into 35,000, looking for some kind of a signal candle like a doji or spinning hanging man, excuse me, and then moving higher from there. So there might be some interesting plays coming down the pike here. Probably needs a few more days. I'd be looking like Thursday, Friday for the Dow Jones. Wrapping up, looking over to Bitcoin, nothing really to see here. I am impressed that it has held up as well as it has here. We had a couple of breakdowns on the 18th and then again on the 20th that looked like they might pick up steam and come back down to test the 50-period moving average. That did not happen. And it is fighting the good fight. Not really interested here, at least until we get above 30,515. But honestly, ultimately waiting for the breakout on the weekly chart. That is going to be the real trade here, is when we take out highs on this weekly chart. Going over to crude light, last but not least, well, actually second on last, I want to talk about gold here in a second too. Crude light starting the week off with a little bit of weakness, not out of the ordinary, since we are coming right up against the decreasing 50-period moving average on the weekly chart. On the daily chart, pressing up into the 200, that is also acting as overhead resistance. And honestly, I would love to see this just kind of go nowhere between the 200-period moving average and this rising 9-period moving average. If we can see this consolidate here in that zone throughout this next week, going into the following week, any breakout above this 200-period moving average would be playable to the upside and could have a potentially significant move. So we're asking the trading gods to set that up for us. We'll see if they give it to us or not, but I would love to see 4 or 5 days of consolidation here with a break the following week. So finally, gold, before I go out to economic data. So gold, we got a nice pop to start the week, pulled back hard. It's now sitting on top of both its 9 and 50-period moving average, and it's fighting the good fight. It's hard to say if it's really going to stick the landing on this yet or not, and that's really going to depend on the economic data that we have coming out. If we go out and look at the US dollar, we did get a nice ramp up in the US dollar here. We would be looking for this to roll over. So if we take out the low of today, and start moving back lower, that would be bullish for gold. If this continues to ramp up higher and comes back up into the $28 range and starts pushing up higher into the like 28.75, 28.80 range, that would be negative for gold. So looking for this chart to roll over. And that is going to be heavily impacted by the economic data that we have coming out. So to wrap up the video here, just giving you the economic data that is going to be coming out this week to be aware of. Monday, we have flash manufacturing PMI that is going to be very important. Consumer confidence, not super important in my opinion. The FOMC statement and their fund rate decision is going to be very, very important. Honestly, I think that supersedes pretty much anything Monday and Tuesday, even though manufacturing PMI will be important. I think we're going to have a fairly narrow trading range leading into this federal funds rate. It is widely expected for them to raise by 0.25%, going from 5.25 to 5.50. And you can see that if you go out to the Fed Watch tool, there is a 0.8% chance, so almost nothing chance that they leave the current rate as is. Basically, the entire market is anticipating a 25 basis point raise. Going out to Thursday, unemployment, and Friday, we have the core PCE. This is the price index. I would love to see this come in at 2 and match the forecasts, or even maybe beat the forecast, come in maybe at 0.1 instead. But it is nice. We are continuing to see this decrease. And basically the core PCE looks at the price to end consumers of goods in the marketplace. So if we see this coming down, it basically means that the increases to prices that we as consumers pay is decreasing. It doesn't mean that prices are decreasing. It means the rate of gain of the price increases is decreasing, if that makes sense. I know that's kind of a tongue tie. Anyways, hope that helps, guys. Let me know if you have any questions. Let me know in the comments if you need any help looking at these charts, or if you want me to go into any more explanation about some of the indicators that I use here. I did just drop a YouTube video looking specifically at RSI and MACD indicators and talking about the convergence and divergence signals that I've been using a lot here recently as I gauge the overextended nature of the chart. So if you haven't seen that yet, check it out. Talk to you guys soon.